Greetings, members one and all of the Salivation Nation. You know, there are some people that cut themselves shaving, but me, I'd cut myself mowing. Now, what does it have to do with gold being fundamentally overvalued? I have no clue, and I don't care. That's right, we're going to take a look at this article here from Seeking Alpha. It's quite interesting. I like to see what different philosophies are on gold from commodities experts and the like, and try to sort of eke out the motive behind some of it. But even if you can find a motive, I don't discount any information from anybody, as long as it's not way out there or over the top or whatever. But I found this kind of fascinating, so we're going to explore this together, and maybe in the end we can figure out why I cut myself mowing. So this is an article here by Oleg Kombiaev. I guess a Russian, I'm not sure. But if you look at here, he's into commodities, internet, medium term, horizon, his specialties, and ETF investing. And to me, that kind of says something, because probably this guy, is my guess, is he doesn't actually hold any gold. But let's kind of explore it and see this. The summary is contrary to traditional opinion. There's no stable long-term correlation between gold and the VIX index or the S&P 500 index. Gold is in a strong long-term relationship with the value of the dollar and the level of the U.S. real interest rate. I do agree with that, but I don't know about the first point. Neither the dollar nor the real interest rate has dropped so much that this could explain the current price of gold. So he has an investment thesis here. The analysis of the gold market prospects amid the actual driver indicates the risk of a correction in gold prices, and consequently the SPDR Gold Trust ETF, which is tied to gold. And that's the important thing. It's not gold itself, it's tied to gold. And in my view, this is kind of very interesting because to me, this tells us that he's admitting that it's not necessarily a direct correlation. In other words, there's no one-to-one ratio between ETF and gold itself. Maybe that frees it from having to be actually backed by gold, only tied to it. There is a difference there. His analysis begins with a review to the degree of activity of the key gold market drivers. Firstly, contrary to traditional opinion, there's no stable long-term correlation between gold and the volatility index. And to a point, I agree. It is obviously closer tied to the dollar, but the volatility index, or what's also known as the fear index, I believe does have an impact of some sorts. But here we can see the volatility index in gold based off of a 3-day return. So here we can see the correlation between the two. 360 day to 30 day there. And in the same way, there's no stable correlation between gold and the S&P 500. And there we see the correlation coefficient and the measurements thereof. There is more or less a significant long-term correlation between gold and yuan's value denominated in dollars, but it is not strong enough to build a model. And there we see the difference. That's a little bit more sporadic there. Finally, a sufficiently significant correlation is becoming apparent between gold and the dollar. The fact indicates that the dollar invariably plays the most direct role in the fate of gold, and I do agree with that. And here we see the chart here. So look at that big spike there. There is another driver that traditionally has a strong impact on gold, and that is the U.S. real interest rate. He wants to note that the indicator incorporates two indicators, the 10-year Treasury yield and the rate of inflation in the United States. In view of the limitations in calculating the correlation, he cannot provide an appropriate graph, but even a visual assessment proves that the level of real interest rate has a considerable impact on gold. There we see it. So gold in the long-term relationship with the value of the dollar and the level of the real interest rate. And now we'll do the following. Based off the history of the last 12 years, they'll build a statistical model that will predict the price of gold based off the value of the dollar, the level of the real interest rate, and the combined effect of these two parameters. It will not describe the process of building a model in detail due to its tediousness and will only give its final parameters. And that is another key to how some of these numbers. And that's why I've never really been a big fan of technical analysis as such, because there are so many ways and different factors and variables that can be tweaked to really make it say whatever you want it to say. Notwithstanding, I appreciate and have great respect for people who do this kind of analysis. But in my view, it's got to be explained in a detail order, or else it could be questioned. Here we see it, observations, and look at that. There's a lot of math involved. Some of it I don't understand. A lot of it I don't understand. And the assessments. And then he's built out this model. The predicted price of gold, and there's a better correlation there than we see here. And its predicted price will go up there based off these variables. It is quite interesting to see. You can see the close tie here. I mean, there are some variations here, but by and large, it kind of sticks together. No argument there. It says it's worth noting that the historical context, the model has had its successes and failures. For example, the model was wrong predicting a drop in the price of gold in early 2011, but it rightly determined that in August 2011, gold was overbought. But the most interesting is that since 2015, the model has been predicting well, and the balanced price of gold around which its actual price fluctuates. The current price of gold is rated as overvalued, according to that model. Keep in mind, 2011 was an anomaly. And I think that's the thing that we'll have to consider here, which will give my ultimate analysis here at the end. So the final thoughts are, I think that for the last 6 months, the gold market has been growing in advance. That is, neither the dollar nor the real interest rate has dropped so much that this could explain the current price of the gold. Probably the market believes that the situation will change in the future and the dollar will become cheaper and the real interest rate will decrease. By the way, the author also, he thinks as well that it will as well. But for the time being, it seems that the gold market is in suspense and the probability of correction to the level of $1,200 is very high. Apply the foregoing to the ETF GLD, a fund which tracks the price of gold. I believe that the price of the fund is prone to a short-term correction at the level of $118. So there we go. And this is good analysis, but what it doesn't take into mind, and what I think the fundamental flaw of this analysis is this, is that the fear index, a volatility index, influences the dollar. So I think that that's the thing is, so the fear index and the S&P 500 is also driven by emotion as well. So when you take into that account, emotion, consumer confidence, other numbers, GDP and all that stuff, however these numbers play out, there's so many different factors, and notwithstanding black swan events or unforeseen things that can happen that aren't necessarily crises, but cause a little bit of nervousness in the markets, Brexit, and all that stuff. All of that has an effect on the volatility index, which has an effect on the markets, the S&P, the Dow, which in turns has an effect on the dollar. Because confidence, the dollar is only as good as the faith in it. Yes, it is a fiat currency. It is decreed by our government and by governments around the world for your associated currencies as backed by the government and good for transactions. But those transactions are only as good as the people with whom transact. So therefore, it is all based off of faith. Faith in what the government tells us about that dollar, hence where the dollar is. And there's been talk about what's going to happen when the dollar index goes up to 97 or even go up to 100. Well, the price of the gold is going to go down. And that very well could happen. The ultimate analysis of this could be right, but it's discounting what drives. It's not looking at what the past is as far as, or what the other factors that come into play that affect the dollar index. Believe you me, there's a lot of psychology behind it. There's a lot of emotion behind it. And so therefore, gold being overvalued, perhaps so, but maybe not. It's this does not say, just like the author had admitted in his model did not match for what happened in 2011, and we saw other places in the model here that were off and separate, as far as the actual predicted price of gold. And so therefore, it's It's one of those things where, we just acquire it as we can. And, it's fun to look at these numbers and to talk about where the price of gold is going. Because in my mind, and the reason why I do videos like this is because it further bolsters the point. It gives us more confidence that what we're doing is the right thing, and we see real world examples of gold reacting based off of the markets. And with what the markets do, typically whenever there's economic instability or a little bit of fear, well, gold goes up. Why does it go up? Because the dollar, people lose faith in the dollar and they go to safe haven assets. So there you go. So post your thoughts below. Fascinating indeed. I did misinterpret this chart. It's the blue here that's predicted. So it's predicted down to $1,200 when the actual price is, closer to the 1350 level there. So post your thoughts below. We'd like to extend a multitude of gratitude to y'all for watching and encourage you to please rate, share, comment, and subscribe. Now, the reason why I cut myself mowing is because I hit my knuckle on the lawnmower, and I didn't really even realize it till I was done and just started doing this video. And it's bleeding a little bit, and it hurts a little bit. First world problems. I'll be okay.